So good afternoon, everyone, or I suppose just about good afternoon, and welcome to our seminar on productivity, prices and international trade. So for anyone in the room who didn't hear the fire exit warnings earlier, I'd like to point out fire exits. If the fire alarm does happen to go off, please leave via these rooms and follow CSO staff down the stairs. And I would kindly ask you to put your mobile phones on silent, please. And we will have lunch in the coffee area after the seminar. Obviously, that's just for people in the room. We couldn't do much for the people at home, unfortunately. And we will have three very interesting presentations today. So first, there'll be a presentation on productivity in Ireland from Doireann O'Brien, who works in National Accounts. Second, there'll be an update on prices with a focus on the Consumer Price Index from Anthony Dawson, who works in prices. And two people who aren't sitting up here yet will be presenting on interactions with the US, a look at the US current account and US trade and goods, which is jointly given by Lucia Perez Alfaro from Balance Payments and Jane Burmanje from International Trade. We'll take questions at the end of each presentation. And can I ask people who are online if you use the chat function or raise your hand and we'll get to you also. But we will have people in the room with questions too. A recording of today's presentations will be made available on CSO's YouTube channel. So now I'd like to invite Doireann to talk to us about productivity in Ireland. Thank you, Doireann.
Thanks, John. So hi, everyone. And first of all, thank you for sticking around for this afternoon's seminar. As John said, my name is Doireann O'Brien and I'm a statistician here at the CSO working in the National Accounts Division. And I look after productivity statistics along with my colleague, Ken Kennedy. So the purpose of my short presentation today is to not only take you through some of the latest results that we've published in the area of labour productivity, but also to explain a little of the intuition behind some of the statistics that we compile. So in labour productivity in the CSO, we have two principal statistical series, the first of which is the annual productivity in Ireland series, and the second is the quarterly productivity in Ireland series. And so in today's presentation, I'll take you through some of the results that came out of the latest iterations of both of those two. I'll then briefly touch on some developmental work that we're currently undertaking, so you can expect what to see down the line. I'll then briefly flag our productivity liaison group in case that's something you might be interested in. And as John mentioned, any questions that come to mind, I'd be more than happy to take once we get through the slides. So I thought we would start for anybody coming to this seminar from outside the world of labour productivity statistics with what does labour productivity actually mean? What does that statistic capture? Labour productivity is a key macroeconomic indicator for any economy, and it measures the efficiency of an economy's labour force. And as you can see on the slide, it's measured quite simply as output per hours of work. Now, higher values of labour productivity indicate a more efficient usage of an economy's labour supply. So for anybody sort of unfamiliar, I'll give a concrete example to try and make it clear. So the typical example you might point to make labour productivity clear would be something from the agricultural sector, specifically dairy farming. Think of the invention of the milking machine. This invention would have enabled farmers to produce the very same level of output, in this case milk, while dramatically reducing the number of hours of work. And so that type of development would show up as an improvement in labour productivity in our statistics. Of course, in our statistics, we're measuring output as gross value added at constant prices. So generally, increases to labour productivity will most typically be driven by influxes of capital into a sector or an economy, as well as technological improvements. For Ireland specifically, it's important to note that globalisation factors do impact our labour productivity statistics, so the presence of multinationals in the economy. So now with that clear, I'll take you through some of our latest findings from our latest Annual Productivity in Ireland publication. So our latest iteration covered reference year 2023 and it was published on the 1st of April 2025. So these results based on 2023 would have been based on the annual national accounts results that would have come out last year. So now with the publication of 2024, ANA work begins on the 2024 labour productivity statistics. Now, as you can see on the infographic, we produce a whole suite of complementary statistics. So there in the middle, labour share. This is something that we'll touch on in a few slides. Capital assets per employee, multi-factor productivity growth. But there on the left, you can see our key statistic of interest, the one that I just explained, labour productivity. And a key conclusion that falls out of not just our 2023 annual labour productivity results, but across all of our productivity analysis, is that there is a key disparity in terms of labour productivity between the foreign sector and the domestic sector of the Irish economy. So you can see here on the infographic that labour productivity reported by the foreign sector was over 6 times that reported in the domestic sector of the Irish economy. And as you'll come to see as we go through some of the results that we published, a huge driver of this disparity will be the capital intensity of the foreign sector. In this graph, we're showing you labour productivity over time, broken down by the total economy and then the domestic sector and the foreign sector. And you can see here that this disparity between foreign and domestic has been a long-held feature in these statistics. So in 2023, you can see there the total economy represented by the navy line reported labour productivity with a value of €105.8 per hour, and this was down from €114 per hour in 2022. If we look at the domestic and foreign sectors of the Irish economy separately then, for the domestic economy represented in the green line there, we saw labour productivity stand at €61.1 per hour in 2023, up from €58.8 per hour the year previous. And for the foreign sector, a very different picture emerges. We see labour productivity at a value of €388.9 per hour in 2023, down from €455.9 per hour in 2022. So before we go through another selection of results from this publication, I thought it would be best to pause and take a look at how we actually break down the economy between foreign and domestic. So how do we actually get at these categories of the foreign-dominated sector of the Irish economy and the domestically dominated sector? So just like in the annual national accounts, we use what's called the dominance criteria. So the dominance criteria states that if 85% or more of a sector's turnover is generated by a multinational corporation, we classify that sector in its entirety as foreign, or more specifically as foreign dominated. And then any sector that doesn't meet that threshold of the dominance criteria, we classify that as domestic or domestically dominated, to be specific. And so familiar sectors such as pharmaceuticals, such as IT, and the others there listed on the slide are categorized under the foreign dominated sector in alignment with this dominance criteria. And to show you visually how this looks, you might not be familiar with NACE sectors, but 2-digit NACE sectors is a level of specificity in terms of our sectoral classifications. So we apply this at this level. We identify which sectors have a concentration of foreign activity. We then remove those sectors from the results in order to arrive at labour productivity for the domestically dominated sector. So we'll use hours and GVA data on these remaining sectors in order to compile the domestic specific results. And of course, the other side of that coin, we do the same for those sectors that we strip out to arrive at foreign dominated labour productivity. On the slide, I'm showing you what we do for the manufacturing sector. You can think of this for the entire economy. And it's very important that we do this, that we do split out the Irish economy between foreign and domestic dominated. And to illustrate this, we can take a look at the European comparison. So for instance, this graph compares Irish labour productivity. Here, Irish labour productivity is the total economy value, and we compare it to a selection of our European peers. You can see here that Ireland reports the highest value of labour productivity in 2023. Now, of course, on the slide, we're just showing a selection, but even when we look at the entirety of the European Union, Ireland does report the highest value. However, when we do this work and we strip out those foreign-dominated sectors like the pharmaceuticals, like IT, you can see just how far back Ireland's labour productivity value falls when we're looking at the domestic sector specifically. So we fall to be within a labour productivity value that's within €20 per hour of the EU average, which stood at €41.9 per hour in 2023. If we add back in then the foreign-dominated sector, you can see just how much of an outlier Ireland's foreign sector labour productivity is here relative to the rest of Europe. Let's turn now to focus on labour productivity growth. So while labour productivity declined by 15.9% in the foreign sector, in the domestic sector in 2023, we actually saw labour productivity grow by 3.8%. And so for the next couple of slides, we'll focus on the domestic sector specifically. On this slide, you can see growth in labour productivity in the domestic sector over time, and this is represented by the orange line here. And as you can see over time, growth in labour productivity for the domestic sector tends to fluctuate above and below zero. In the publication, we break down labour productivity growth into two main drivers, with these two drivers being capital deepening and multi-factor productivity. So I'll explain what both of these actually mean. Capital deepening reflects changes in the capital available to labour, so changes in capital per hour of labour, so changes to machinery, equipment, infrastructure, but also importantly, intangibles available to labour, which can make each hour of work more productive. Multi-factor productivity growth reflects all of the non-capital drivers of growth. So positive multi-factor productivity growth may indicate items such as innovation, agglomeration and spillover effects, economies of scale, as well as organisational structuring and management practices. To understand the intuition of multi-factor productivity, in case it's not so clear, you can think of a simple example. If we saw in the statistics that output grew, so if GVA grew, however, both labour and capital remained constant, that growth would be wholly attributed to multi-factor productivity growth. So in that way, it's like a residual category, a catch-all for what we can't measure in labour or capital contributions. In 2023, you can see that multi-factor productivity growth wholly drove the growth in domestic labour productivity, with capital deepening actually dropping, however, very marginally. We can also look at this growth decomposition between multi-factor productivity and capital deepening on a sector-by-sector basis. So here we're showing you each of the domestic subsectors within the Irish economy, with the orange scatter points here denoting sector-level growth in labour productivity in the year 2023. So as you can see, some of the high growth sectors in the economy that year included electricity, gas, steam and air conditioning supply, with growth of over 60% in the year. Labour productivity, in contrast, declined, albeit a lot more modestly, in other sectors within the domestic economy. So some examples of negative growth were reported by arts, entertainment and recreation, as well as wholesale and retail trade. In the publication, we also devote a chapter to a statistic which we already came upon in the infographic, which is called the labour share. The compilation of the labour share is somewhat complex. There's a few steps to its calculation. However, what's important for today is the intuition, and the meaning of this statistic is actually highly intuitive. It simply seeks to capture what proportion of output or what proportion of GVA is attributable to labour, as opposed to capital. So here you can see on the graph, if we focus on 2023, that Ireland's total economy here represented in navy shows that total economy GVA was attributable to labour at a rate of 32%. For the domestic economy, the labour share stood at 53.5% in 2023, and again a very different picture emerges for the foreign-dominated sector, which saw just 10.2% of GVA attributable to labour that year. So if that's the focus on labour, the other side of that analysis is getting an idea of capital intensity. And so we also have a chapter in the publication focused on capital. And our capital chapter makes use of our key statistic, which is capital assets per employee. And as you can see immediately on the graph here, a key outlier among our European counterparts is, again, Ireland's foreign sector, reporting capital assets per employee with a value of €1.5 million per employee. In the domestic sector then, if we look at that distinctly, we see capital assets per employee at a value of €305,000, ranking between the Netherlands and Germany. So that's all I'll show you of our annual publication. Now, I will stress there's more analysis contained within the publication, things like the unit labour costs, as well as claims analysis. So I can point you to the publication for more information and analysis there. And this is on the CSO website. I'll also stress that the vast majority of the statistics which we publish in that publication are fully in adherence to an internationally agreed upon methodology set down by the OECD, and this ensures that we're internationally comparable. So now with the annual national accounts publication, work begins for us on the 2024 productivity results. And so you can expect to see the earliest productivity statistics for 2024 come out before the end of the year. So you can keep an eye out for that. I'll briefly touch on our quarterly series. So our quarterly productivity in Ireland series covers nearly all of the statistics that we look at in our annual series. However, of course, in less detail given the frequency of this product. So this release tends to be of major interest to both our users and the media, and this is because our quarterly productivity results constitute the most up-to-date productivity statistics that we have, with a timeliness of T+3 months. It was most recently published on April 3rd, covering the reference period Q4 2024, and the next iteration will be published within the next couple of weeks on the back of the quarterly national accounts for 2025 Q1. So these will be based on the results that you just saw presented on this morning. The 2024 results coming out of the quarterly series show a different picture for the foreign and domestic sectors. Foreign labour productivity appeared to drop in the first half of 2024 before rising again in the second half of 2024, arriving at a value of €410.8 per hour in Q4 2024. For the domestic sector, labour productivity showed a slight but consistent overall trend across the 4 quarters of 2024, arriving at a value of €59.6 per hour in the last quarter of that year. So before we go to your questions, I'll just briefly mention the developmental work that we're undertaking on the team for productivity statistics, just to give you an idea of what you can expect to see coming down the line. So I explained earlier in the presentation how we achieve the split between foreign and domestic for the Irish economy using our dominance criteria. So just to remind you, we identify at this level of specificity where foreign activity is concentrated, and we remove those sectors from the domestic results and treat them separately. Now, this approach is very reliable for a number of reasons. For instance, this is the most suitable approach we can take in terms of international comparability. However, to complement this approach, we're now doing some developmental work to make more detailed estimates. Now, these would be estimates, but to make them as detailed as we can, as you can see illustrated here on the slide. And this is with a view to facilitating our users do the type of analysis that they're interested in doing. So these estimates of the more detailed split are being done in order to add that additional insight for those who wish to get a picture of the Irish economy when that foreign activity is stripped out. And if the topics that we covered in today's presentation are of interest to you, the developmental work that we undertake is informed by the needs of our key stakeholders and users, who we now meet with via our newly restarted productivity liaison group. And so if productivity statistics are something that might be relevant to your projects and you're not already a member of our liaison group, definitely feel free to reach out, and I'll leave my email here on the slide. But that's all for me, and looking forward to your questions.
Thank you very much, Doireann. That's very interesting. So now I'd like to invite Anthony to talk to us about prices.
Thanks, John. So hi, my name's Anthony Dawson. I'm a statistician in the consumer prices section in the prices division down in Cork in the CSO. So as kind of what I'll go through today is I'll kind of talk about consumer prices, what are the recent trends, what recent developments we've made in the consumer prices area, and the upcoming developments we have in store. And then I'll touch briefly on some of the other developments going on in the prices division, so residentially zoned land statistics, commercial real estate indicators, and residential property transactions by non-households. So just to get started, just on the CPI and HICP, these are the products that the consumer prices section in Cork produces. So we've got the consumer price index, the harmonised index of consumer prices, which is the European measure of inflation. We also produce a flash harmonised index of consumer prices. This is the press statement we put out at the end of the reference month. And we also send Eurostat harmonised index of consumer prices at a constant tax level. So then just to look at the recent CPI and HICP trends. So what we've seen is that inflation has decreased gradually since the October 2022, when it peaked at 9.2%, and HICP previously peaked at 9.6% in June and July of 2022. We've seen that come down to an average inflation rate of 2.1% in 2024, and the latest figures for May 2025 showed that CPI was running at 1.7% and HICP was running at 1.4%. The main difference between these two sort of indices, or these two inflation rates, is mortgage interest. It kind of causes the divergence between the two rates, where when mortgage interest was low during the peak inflation in 2022, you saw that it was kind of keeping CPI down, whereas now now that they've got mortgage interest rates have gone up, you're seeing it kind of keep CPI above that HICP rate. So those are the figures for May 2025. As I say, we've got June figures released then on this Thursday coming on 10th of July. Just drilling down into those recent trends a bit more. For 2024, as I said, we saw a slower rate of inflation than in 2022 or 2023. Services price inflation was the largest contributor to this, as you can see in kind of the graph there on the right hand side. This was offset by decreasing energy prices, so that's your gas, electricity, those things kind of came down over the course of 2024, kind of offsetting that inflation rate that services had. And we also saw then that for the majority of 2024, the price of food, so that's the food in shops, was flat for quite a lot of the year actually, and then began to increase slowly over the end of 2024, heading into 2025. Staying into 2025, we've seen, as I said, inflation was 1.7% in May. The biggest contributor to this was restaurants and hotels, which was 0.56 percentage points. So that's of that 1.7%. A third of it pretty much was made up of the restaurant and hotel sectors. Food and non-alcoholic beverages then came in at 0.41 percentage points. And again, kind of looking at that graph on the right hand side, you can see that those decreases were kind of offset by decreases in energy prices. This mainly have been sort of your petrol, your diesel and your home heating oil over the course of 2025. Those prices have come down. But as we can see there, kind of food is continuing to creep up, and it's kind of the main talking point at the moment you see kind of is around the food price inflation. So then just to touch then on some of the developments we've made since the onset of COVID-19. So some of the methodological developments we've made are clothing and footwear and travel goods. So we made this change in June 2021. It improved the replacement method we had for items that had left the market. So when clothes go out of stock or go out of fashion, what's replaced them, we improved how we go about replacing those. We updated our motor car insurance methodology in January 2022, increasing the number of quotations we were using web scraping. This just improves the representativity of the index. We updated how we calculate direct pricing relatives by source. I'll go into this in a bit more detail in February 2022. And then in January 23, we updated our package holidays, again, just improving the index, making them more representative of the seasonal nature of the package holidays. We published a rebase in December 2020, or in January 24, where we've rebased to 2023 equals 100. And while we did this, we updated the CPI basket of goods, making the basket more representative of what people were buying over the course of the years. And then finally, the home insurance, again in January 2024, we increased the number of quotations using the web scraping, just again to improve that representativity of the index. So then just going into, as I mentioned, that change in direct pricing methodology. So direct pricing is the collection of prices at the point of sale. This is basically retail outlets. So this is your shops, this is your high street services as well. So before COVID, we had 100 prices going into stores and other retail outlets around the country. All of the prices on this side were collected by those prices in the stores. And since then, post-COVID, we've incorporated maybe a mix of data sources, the best way to put it. We have 30 prices around the country, so predominantly in the big cities and then in the larger county towns. But we've also then supplemented this with prices collected online from retailer websites, directly in the CSO offices. And also we collect transaction or scanner data directly from the retailers. And I'll go into these in a bit more detail. So just then, because of this change in how we collect data, we had to kind of change how we calculated our relatives. So these relatives are the percentage increase from 1 month to the next of our elementary base set items. So your elementary indices are basically the 612 items in the CPI basket. So before COVID, we had aggregation based on CPI pricing areas. So this was Dublin, South West, Border Midlands West, Midwest, Mid East, South East. So what we used to do was we used to get a geometric mean of all the prices collected within that area by our basket item. We then weighted those elementary price indices based on the populations in those areas, and this allowed us to get a weighted average elementary price, which is then calculated for the current and previous month, and the change in those is the price relative. Since COVID, we've had to change that, so we now aggregate based on the source of the data. So this is the field pricing, that's those 30 prices that are out in the field, the prices collected by the staff online in the office, and also then our scanner data that we receive from the supermarkets. It's fairly similar after that. We just get the geometric mean by each source and then produce a spares type index based on the importance of each source. And those weights were then based on Kantar supermarket shares plus some estimations that we made. So just to go into the scanner data in a bit more detail, the scanner data, it's weekly data we receive from retailers. That's all of the items that pass through the scanners or the tills that week. So what we receive is we receive the total revenue by product in the store, the volume, I suppose, of sales of that product, the product descriptions. So that's the label, what it's called, but also what aisle it's in the shop. So that can be broken down kind of to food, further down then to your fresh dairy, down to milk. And we also receive the barcode for that item. So we currently have 2 supermarket datas being used in production. We have 2 more providing us data, and we'll be putting those in production soon. And basically, the scanner data just allows us to cut down the amount of in-store pricing that we do. It allows us also to account for the discounts and offers more effectively as we collect sort of a unit value price for the item. So then, just touching on some of the upcoming developments. So the first is the upcoming CPI and HICP reclassification to eCoiCop version 2. So why is HICP changing to ECOICOP version 2, and when is it happening? So ECOICOP, which stands for Classification of Individual Consumption by Purpose, that is how we define what products each item, or classify what each item in the basket is. These classifications have become pretty obsolete since they came into effect, and it's becoming more difficult to classify some of the new products that we're seeing enter into the baskets. And also the boundaries between categories are more blurred. It's harder to kind of put something into one or the other. It takes a lot of work to try and work out what it is. Some of these issues are resolved by the move to the ECOICOP version 2, and it just gives us a better understanding of what sector is contributing to inflation when we look at it under these new classification scheme. So the new requirements will apply to the transmission of our HICP and our constant tax starting in January 2026, and this also coincides with the rescaling of the HICP to 2025 equals 100. So what changes? There'd be a reclassification of all historical data from 1996 to 2025. There'll be no change to the all items HICP for historical data. So this is the overall HICP rate, kind of as I mentioned before, the 1.4% in May. That won't change. What we will change is some of the divisions due to the moving of items from one division to another, and I'll go into that in a bit more detail in a second. But I suppose, as I mentioned, that overall figure doesn't change, and that's because it's built up from those 612 elementary items. So that, they'll still all be in there, it won't make a difference. From January 2026, the published HICP series will be in this ECOICOP version 2, and there'll be no methodological changes, so again, the all items will stay the same. So what changes classification-wise? There's extensive revisions to Division 08, Communications, and Division 09, Recreation and Culture. I'll touch on these in a second. Division 07, Transport, now includes the transportation of goods as well as passengers. And there's a new Division 13, which touches on which does personal care, social protection, and miscellaneous goods and services. And a full detail of this can be found on your UN COICOP 2018 classification manual, or if you want a bit more information on it, just give me a shout after. So then this is basically a breakdown of Division 8, just to give an idea of what's going on. So ECOICOP version 1, we saw that Division 08 was just communications, and it only had those postal services and telephone equipment and services. And in that then you had your mobile phones and your internet and the bundled services that you can get. Whereas it becomes a bit more, I suppose, a bit more clear and a bit more sensible with the ECOICOP version 2, when it moves to being information and communication. So you see that you've got your information and communication equipment. So that's, not only just your mobile phones and your landline sort of telephone equipment, but it's also your computer accessories, your computers, and the televisions and media devices, which were previously in 09, Recreation and Culture. It makes more sense for them to be alongside, in my opinion, alongside the information and communication equipment. 08.2 is now software excluding games. Again, this was computer software was previously in 09. And then you've got a new one, which is the information communication services, which, again, mobile landline services, internet, but you've also got your telecom services and TV license and streaming services. Again, they were all previously in 09. So what impact will this have on the Consumer Price Index? We feel it makes sense to reclassify the CPI along with the HICP to avoid any confusion, but feedback on this is welcomed. Again, same as the HICP, no change to methodology, and that all items figure will remain the same, even when revised backwards to 1996, which we plan to publish on PXStat, sort of mirroring what's currently available. We will update users once Eurostat have published the details on their website, so we'll put out our own communication documents once Eurostat have published the details. So then just some other developments that are going on in the consumer prices area. We're looking to, as I mentioned, expand the collection of scanner data. We're bringing more quality improvements, especially around the area of the non-energy industrial goods, or NIG. And then Eurostat are looking to get owner-occupied housing into the HICP. So we're engaging with Eurostat on these developments. Then just around some other price developments that are going on. So we've got the residentially zoned land prices. So we're preparing a frontier release on residentially zoned land. So from 2018 to 2024, we'll produce the following indicators around volume of the hectares, the value of the hectares sold, the mean price per hectare, and the median price per hectare. And the plan is to publish a frontier release at some time in 2025. In addition to that, there's development on statistics around commercial real estate to meet an upcoming EU regulation. So the variables we need to transmit for this are building permits, construction starts and work completions, commercial real estate price indices, as well as commercial real estate rent indices, and then value of transactions of commercial real estate. Consultations on the Basic Act are still ongoing at a European level, but as it currently stands, 2027 will be the base year with the first transmission required in 2028. Larger countries will be required to transmit quarterly, and small countries are transmitting annually. Then just around the residential property transaction by the non-households. So some of the key findings from the release we published last week at this stage, last week, 1st of July. So we saw 12,600 dwellings were purchased by non-households in 2024. 20% of the total market purchases in 2024 were made by non-households, and 5 billion was spent on residential, or by non-households. This is up from 4.2 billion in 2023. We've seen that the most active buyer is the public administration, education, health and social sector. They're buying 6,500 dwellings worth 2.6 billion. Almost 21,000 dwellings were sold by non-households in 2024. This was up from 19,000, and this was 9 billion sales, up from 7.5 billion in 2023. We've seen the most active seller is the construction industry, selling 13,500 dwellings worth 6 billion. So we've seen then that Irish registered companies and institutions account for 4.8 or 95% of the 5 billion spent on purchases of residential dwellings in 2024. And more information can be found on the release, as I said, that was published last week. So just to take a look into some of the figures just around this, the value of non-household market purchases of residential dwellings, fileable revenue by nice sector. So we've seen that there's been a large increase in the non-household market purchases since 2018. And you see then that, that public education and health sector are kind of driving those purchases. They take up the majority of the value of the purchases. So I think that's it. Yep. So if anybody has any questions, I'd be happy to take them.
Thank you, Anthony. If we can get the next presentation up.
Yeah.
Let's go.
Okay, there. So, hi everyone, I'm Lucia, I'm a statistician in balance of payments analysis and dissemination. And I'm here with Jane, who's a statistician in international trading goods. We'll be going through the interactions with the US from the perspective of trading goods and the broader balance of payments. So in order to do that, we'll first go through some definitions before diving into the trade and current account data. And lastly, we'll go through a new output we've developed, which is the international investment position with the US. So turning to the definition, what is the current account and what is trade? Firstly, in the broader balance of payments, we look at the interactions between Ireland and the rest of the world. The current account is part of balance of payments and focuses on three main items: merchandise, services, and income flows. In merchandise, we are looking at the import and export of goods. The main data sources for merchandise in the current account are cross-border trade data, which is mainly data collected by VIMA revenue, together with adjustments made to account for contract manufacturing and merchanting. So it's important to note here that the goods trade published by the trade division will not match what is published as goods trade in the current account. And this is because cross-border trade looks at the physical movement of goods across borders, while balance of payments is compiled on the basis of change of economic ownership. And yeah, there's further information about the differences in our website if anyone is interested. In services, we are looking at the import and export of services, and the main data sources for this are balance of payment surveys, large cases units, and annual services inquiry. The income flows is the income payable or receivable from the use of resources, and the main data sources are balance of payment surveys, large cases units, the annual services inquiry, and the census of industrial production. So turning specifically to trade with the US and the US current account. So here we have the current account with the US. This is compiled on the basis of the next counterpart geography. So in this graph, we can see that the US current account balance fluctuated around zero from 2016 to 2019, and then became increasingly negative during 2020, 2021, and 2022, before stabilizing in 2023 and 2024. And there are two reasons for this. So one is the service imports. From 2019 to 2022, the total services imports stayed approximately the same. However, the geography from where these imports came from changed. The service imports from offshore centers dropped off, and they were counterbalanced with increased service imports from the US. So we have an explanation for what caused the increased negative services balance. The second factor is the income flows. So in particular here we see the direct investment income outflows. So these are multinational profits that US-owned companies in Ireland are sending back to the US. In this graph, we can see the profits that are next counterpart US, so they go to the US with no stop in the middle, and the ultimate investor US, which end up going to the US with a stop or several stops in other countries. The change from 2020 to 2021 was partly due to an overall increase and partly due to income now going directly to the US rather than through affiliates in other countries. So in 2020, around 10% was going directly, and this increased to about 50% in 2021. And the changes in later year are mainly overall changes, which are reflected in the changes to our total income outflows. So looking at the most recent quarter, I'll focus first on 2023 and 2024. So when looking at the annual graph, I had mentioned that the current account balance had remained relatively stable over those 2 years. However, within that, there is a higher merchandise balance and a lower services balance. And you can see that here in this graph by comparing each 2024 quarter with the same quarter in the previous year. So turning to Q1 2025, the merchandise balance with the US is up 37 billion year on year to 50.6 billion. Meanwhile, the services balance with the US has decreased by 21 billion compared to last year, giving us a services deficit in Q1 of 52.5 billion euros. Net income outflows have decreased by 6.8 billion compared with the first quarter of 2024. So the positive merchandise balance is offset by negative net services and negative net income, and this results in a current account deficit of 24.8 billion in Q1 2025, up 9.2 billion from the deficit of 34.1 billion in Q1 2024. So turning to Q1 in more details, we've seen this graph just before in the press conference, and we have here the total current account inflows and outflows. So on the left, we see money flowing into Ireland from various geographies, and these are the proceeds from exports of goods and services and income inflows. And on the right, we have the funding of imports of goods and services and income outflows, like the outflow of multinational profits. And the size gives the relative contribution. So on the left, the inflows are quite geographically spread. And on the right, we can see the outflows, of which a big proportion are going to the US. And this difference between the US inflows and outflows reflects the negative current account balance with the US. Looking at it just for merchandise, on the left, we see a diverse spread of our exports, but with the US making up a higher portion than in previous quarters. And on the right, we see the much lower level of imports. So I'll turn now to Jane, who will give more details on the trade of goods with the US.
Thanks, Lucia. My name is Jane Burmanje and I'm a statistician in the International Trade in Goods section. So I'll briefly speak in more detail about trading goods, looking at trends that we've seen in the first 4 months of the year, focusing specifically on the US. So this chart here shows the flow of imports of goods into Ireland and exports of goods out of Ireland in monetary terms by geographic region for April 2025. So you can really clearly see here that Ireland exports more in terms of goods than we import, and this is particularly true for the US. So in April 2025, we imported 1.2 billion euro worth of goods, but we exported 8 times that at 9.7 billion euro. If we look here at a historical trend series in terms of the value of imports and value of exports between January 2023 and April 2025, you can clearly see here that the first 4 months of the year, we've seen some really interesting trends in the trade and goods data. So between January and March, there has been a really significant increase in the value of exports in goods. Between November 2024 and March 2025, there's been an 80% increase in the value of exports in goods. And we reached a record level of 38.1 billion euro worth of exports in goods in March 2025. There's been a decrease then in April 2025 of 43% to 21.9 billion, but that's still above April 2024 figures. In comparison then, you can see that the value of imports over this period has remained relatively stable. You can kind of clearly see the driver of what's driving this increase in the value of exports in the first 3 months of the year if we break down the exports by geographic region. So for the EU, the UK and all other countries, the value of exports between January 2023 and April 2025 have remained relatively stable, but there's been a really sharp increase in the value of exports of goods from Ireland to the US, particularly in January, February and March of this year. Exporting to the US isn't anything new. The US is one of our largest trading partners, both in terms of exports and imports. So on average, we would export around 33%. So a third of our goods we export to the US month to month. But in March 2025, we exported 67.5% of our goods. And again in April, even though we saw that decrease in the level of exports and goods, we were still exporting 44.5% of our goods to the US. So in comparison, in April 2024, we exported 34%. In terms of imports, while we did see slight increases in imports from the US to Ireland in terms of goods in January and February, the level of imports from the US have remained relatively stable, and the increases in January and February were nothing new or more than along the lines of as we've seen in previous months. If we kind of further analyse those increases in the value of exports by commodity level, and look at what exactly we're exporting in terms of goods to the US, we can really clearly see that it's particular commodity goods which are driving the increases in the level of exports to the US. So this graph here shows the top 10 export commodity goods to the US for March 2025 and March 2024. So March 2025 is represented by the lilac dot and March 2024 is represented by the green dot. So medical and pharmaceutical products and organic chemicals are the two largest commodity groups that we export to the US, but there's been a really significant increase in the level of medical and pharmaceutical and organic chemical goods that we exported to the US in March 2020. Between March 2024 and March 2025, there was an 800% increase in the level of medical and pharmaceutical goods that we sent to the US. So it went from 2 billion to 19 billion. And similarly with organic chemicals, it would also increased 200% over that time period. So from 2.1 billion to 4.1 billion. This story is not the same if we look at the top 10 imported commodity groups from the US, and that the level of imports are incredibly lower than in comparison to exports. Zooming into these kind of commodity groups, we can see that there are slight increases and decreases over this time period, but that this isn't anything unusual or untoward for changes month to month. I suppose just to highlight the significant difference between the value of exports of what we're exporting to the US and the value of imports of what we're importing from the US. This shows organic chemicals imports and exports between January 2024 and April 2025. So we imported just €24 million worth of organic chemicals in March 2025. In comparison, we exported 4.1 billion. And it's a similar story with the medical and pharmaceutical products. So you can really clearly see that sharp increase for January, February and March of this year in terms of medical and pharmaceutical product exports to the US, and that the values of imports for these products is quite low. So in February, we imported €550 million worth of medical and pharmaceutical products from the US, and we exported 10.5 billion, so that's nearly 20 times that. So we've seen some really interesting trends in terms of trade data in the first couple of months in the year. So we saw a really significant increase in the first 3 months and followed by a decrease for April 2025. But it remains to be seen if the decreasing trend is set to continue. And I just point out that our external trade and goods statistics for May 2025 will be published next week on the 17th of July. So to go to the CSO website for more detailed figures and analysis where they'll be available. And I'll hand you back to Lucia.
Thank you, Jane. So come back to the current account and turning to the services. So the overall picture looks much more balanced. However, if we focus only on the US, on the left we have the export of services, some of which go to the US, but they are definitely more geographically spread, while the right reflects the import of services, and we can see the large level of imports to the US leading to the services deficit with the US in Q1. So now for income flows, we have low levels of income flows on the left and much larger levels of income outflows on the right. And these are largely outflows of profits generated by multinationals, many of which are US multinationals, as seen in the large levels of outflows to the US. So now if we move away from the current account, we'll have a look at the net international investment position vis-a-vis the United States. So the international investment position is the balance sheet of the country with the rest of the world at a certain point in time. So in other words, it's the stock of assets and liabilities that Irish residents hold in or owe to other countries. And the difference between the assets and liabilities is the net position in the IIP and represents either a net claim on or a net liability to the rest of the world. We will focus on the assets and liabilities only with the US. So like in the US current account, we are looking here at the geography of the next counterpart. So at the end of 2024, Ireland's net IIP with the US stood at 983 billion, up from 542 billion at the end of 2023. The net assets vis-a-vis the US have generally followed an increasing trend starting from 2015, when it stood at minus 267 billion. Asset positions have grown from 1.1 trillion in end 2015 to 3.1 trillion by end 2024. Meanwhile, liability positions have grown from 1.3 trillion in 2015 to 2.1 trillion in 2024. Portfolio investment assets have been the main driver behind the change in the net IIP. vis-a-vis the US since 2015. And this was mainly due to Irish holdings of portfolio investment equity issued by residents of the United States, which have increased since 2015, mostly due to revaluations. So next we can see how much the US contributed to the total Irish IIP. Looking at the total assets, the US made up 35% of the total IIP, making it the largest destination of Irish cross-border investment. This is particularly due to portfolio investment, and within this, the activities of investment funds that buy equity and debt securities issued by US residents. On the liability side, the US contributed 22% to the total IIP, making it the second largest source of investment in Ireland, behind the UK. If we focus on direct investment liabilities, the US is the largest contributor, reflecting the strong presence of US MNEs that invest in Ireland. So in summary, we have a merchandise surplus with the US, which is related to production mainly by US multinationals that create exports that go to the US and also to the rest of the world. In 2025, we've seen a large increase in merchandise export in Q1 and a decrease in April. We have large amounts of services to support this production, which are imported from the US. The income from the activity ultimately flows back to the US, and the US is the largest destination of Irish cross-border investment. So thank you, and we'd be happy to take any questions.
Thank you for that. Really interesting. So, yeah, I think that's the end of our seminar. So thank you to all of our presenters for their really interesting presentations. Thank you all. And thank you everyone for coming along, whether you're in the room, in this sweltering room, or online. And for those here, lunch is now available out in the coffee area. So thank you everyone.